Hello, good morning from our Prague office with an update on the first half of 2023. Good news, I can confirm we see strong performance. First half of 2023, we've been able to sign many leases with a total of 850,000 square meter. We have been able to sign those leases at an average €5.50 per square meter per month, which is 12% more compared to same period last year, when it was €4.90. So good take-up, a lot of leases at higher rents. CTP remain market leader in the CEE region. We've been able to increase market share in line with our plan and target, and that's good. We remain, and I myself remain in touch a lot with the tenants. I do visit the different countries, the different teams, the construction sites, meet with tenants with whom we have a long-term relationship, listen to what they have to say, what their plans are, their strategies are, and how CTP fit in. In June of this year, I had the opportunity to visit some of our Asian clients. So went to Taipei, Taiwan, and spent a week in Hong Kong to meet with our Asian clients. We have many of them, and we see fantastic opportunities to grow with them in Central Europe for a number of reasons. First of all, rethinking of the supply chain. Obviously, we have seen a lot of supply chain constraints over the past couple of years, and many of our tenants therefore adjust their strategy. One reason, so supply chain, which often means that they rethink their global footprint in terms of where they produce for whom. And what we see is many of our clients have facilities in, for example, Mexico for the North American market. But at the same time, these clients also have facilities in Asia for their Asian business and for their European business. They pick Central Europe as an ideal location to supply their European-based clients. Now, and that's a trend, supply chain related, but also geopolitical reasons. So in short, we continue to build facilities for our Asian-based clients. Infantech is one example, but there are other examples as well, with whom we have been working for the past decades, and we now continue to develop facilities for them in the Czech Republic, but also in Slovakia, as well as in Serbia. A couple other things which I wanted to share with you. On Central Europe, obviously, remains our core business. Our clients like it. Infrastructure well developed, support from local governments. There's workforce available, and also support of getting immigrants to the regions here, whereby also CTP helps with affordable housing, as well as with providing education programs. But also our Western European markets pick up. More on that a bit later. We're looking at the CEE, we still see undersupply, low vacancies overall in the market, and with a good demand and a bit less supply. We've seen that some of the peers and some of our colleagues, they have slowed down their supply, mostly for funding or exit scenario reasons, etc., which is not necessarily bad for us. So in this context, we have delivered another set of strong results. And may I start with the operator, which is the income-producing part of our business. As you know, we split operator, developer from the energy business, those three sectors. To start with operator, 11 million square meter of gross lettable area now means and makes us the largest listed player by GLA in Europe. With that portfolio produces €654 million of income over the next 12 months, and that is up 21.5%. compared to last year. And that is good for strong cash flow, get a lot of rent, €650 million out of that portfolio. Yeah, which is good. Also widely and very diversified with lots of different international tenants, but also local, mostly international. There is more than 1,000 blue chip tenants from a broad range of different industries. So not overexposed to one specific industry. Strong rent collection, as always, 99.8%. Occupancy for the standing income-producing portfolio, a bit lower, 93%. We have been 94, 95, 96. We are currently 93%, which is a bit down compared to last year. Maybe why also because of some properties came to the market, including the Amsterdam City project, which we do in the Harbour of Amsterdam. It's a new market for us. It's a new product as well. So that will take some time to lease it up, although quite positive about the leasing and demand activities. When I jump from the operator to the developer, the in-house construction company, well on the way to reach our yearly targets. We have already delivered almost 300,000 square meter during the first half, which is a lot for the first half because typically you start in spring to complete later in the year. The 300,000 square meter that excludes Amsterdam, that is another 120,000 square meter. 1.8 million square meter of properties currently under construction, again at around 10.6% yield on cost, whereby actually we think we could grow to 11% yield on cost, looking at the construction cost per square meter and the rental income, which, as I explained earlier, we are able to do deals at a bit higher rent compared to what was it before. And the stuff under construction, we continuously lease, and we think, we're going to be around 80-90% again upon completion or before completion. That's for the projects under construction. I wanted to update you on the land bank. 20.7 million square meter of land, 20.7. That is land which we own 62%, two-thirds, in existing business parks, which allows us to extend the footprint, the portfolio, the size of the portfolio, and grow to the 20 million square meter target, which we said we like to hit before the end of the decade. So back to 2023, target is at least to deliver 1 million square meter. More if we see demand. The in-house general contractor concept allows us to adjust timing, speed up or slow down, but also it gives opportunities to do amendments to the property for our clients. Maybe highlight Poland, our largest expansion market, also the largest country in CEE. As you remember, we were lucky to enter the market with an acquisition, currently 450,000 square meter under construction. With good progress in terms of letting, already signed leases of almost 200,000 square meter. And they are also in advanced negotiations with many other parties. And as explained, I am seeing them quite often, every week or second week in Warsaw or anywhere on site in Poland. We see good demand and great future for our business in Poland. With regards to the market in Poland, we have seen significant rental growth, more than 30%, according to the market reports. And that maybe was a nice opportunity for us to enter a year and a half ago. The German team, which we didn't talk about too much, but we see rental growth there as well. At the moment, a few projects already under construction and projects being prepared for construction start during the second half of 2023. So in Germany as well, we see opportunity in this market to get feet on the ground, and we think that CTP will become a sizable and an important player in Germany as well. So all in all, so far quite positive. The other Western European country which I didn't talk about is Austria, where we have been able to complete a project in Vienna at the airport. In the meantime, are doing construction works on 2 other sites in and around Vienna, and it's not a huge market, but very positive about the yield on cost and what the Austrian team have been able to achieve so far. Then let me end with an update on the energy business. We install solar panels on the rooftops and we sell energy to the tenants in the parks, which obviously is much appreciated and in line with the ESG strategy, which our clients do have, and we continue to grow our team. I'm very pleased with the team and its performance, of course. As I explained, the results for the first half of this year are fantastic. The environment has changed a lot over the past 12, 18 months, so that is a compliment definitely towards the team and all our partners and people who have helped us to get where we are by the end of June of 2023. Thank you for your attention. I will be handing over to Maarten and happy to answer any of your questions later on. Thank you so much.
I will now run you through the main financial highlights. We continue to deliver on our promises, on the back of the robust occupier demand highlighted by Remon earlier. We achieved in the first half of 2023 a like-for-like rental growth of 7.5%, driven by indexation and strong rent reversion. 58% of the portfolio is indexed to the Consumer Price Index. The other 42% has fixed escalations. By the end of 2023, we expect around 70% of our portfolio contracts to be linked to CPI. The reversionary potential increased to 14.1%, thanks to the strong ERV growth. We've also been successful in capturing this potential for the leases that came up for expiry. This is illustrated by the average monthly rent per square meter of the leases signed in H1 2023 being 12% higher than the same period last year. Our rental income for the first half increased 21.7% year-on-year to €280.4 million. As we reduced the service charge leakage, our net rental income went up even more, by 26.8% year-on-year. Company-specific adjusted EPRA earnings increased 25.4% to €158.1 million. In addition, the EPS increased 20.5% year-on-year to 36 euro cents, on track to reach our guidance of 72 euro cents for 2023. The gross asset value of our portfolio came to €12.4 billion, up 8.2% compared to 31st of December 2022. The positive revaluations in H1 2023 amounted to €417.2 million and were driven by projects under development, development completions, as well as standing assets. On a like-for-like basis, the standing portfolio saw a positive revaluation of 0.4%, as the yield widening of 30 basis points was fully offset by positive ERV growth of 6.3%. The reversionary yield widening was mainly driven by the Czech Republic, Slovakia and Hungary. Romania, Serbia and Bulgaria, on the other hand, saw less yield widening as the yields in those countries were already higher. With the larger yield movements in Western European markets, the yield differential between CEE and Western European logistics is back to the long-term average. Going forward, with 70 basis point reversionary yield increase in the last 12 months, we expect no further material yield widening. However, we do foresee further positive ERV growth on the back of continued tenant demand, which is positively impacted by the secular growth drivers in the CEE region. CEE rental levels remain affordable, despite the strong growth seen, as they have started from significantly lower absolute levels than Western European countries. The EPRA net tangible asset per share increased from €13.81 as of 31st of December 2022 to €14.84 as at 30 June 2023, representing an increase of 7.4%. This increase was driven by the portfolio revaluation and recurring earnings, partly offset by the dividend we paid out. And now I hand over to Richard, who will run you through the funding and outlook.
Last week, Moody's confirmed our Baa3 investment grade rating with a stable outlook. This reflects our robust balance sheet and access to multiple pools of capital. In H1, we tapped the international unsecured bank market, closing a €280 million first tranche, with a second tranche of €80 million to follow later this month. We also closed €228 million of secured financing with two separate banks. The average cost of this debt was 4.6%, with maturities between 5 and 7 years. In the first week of August, we signed two additional loan facilities, a €200 million 10-year unsecured loan facility and a €103 million 7-year secured facility at a fixed all-in cost of 4.7%. In addition, we have a strong pipeline for further financing, with a material amount of funding agreed, which we plan to draw in the coming months. Our pro forma cash position, including the loan facilities we signed in August, is €991 million, sufficient to meet our cash needs for the next 12 months. Including our €500 million RCF, our pro forma liquidity position amounts to almost €1.5 billion. Our average debt maturity stands at 5.3 years, with a €400 million bond maturing in November 2023, which we will be repaying from available cash reserves. Following this, we have no material debt maturity until mid-2025. CTP's average cost of debt stood at 1.8%. This will slightly tick up going forward as we bring new funding on to finance our developments. 99.4% of our debt is fixed or hedged until maturity. Thanks to our strong cash-generating portfolio, we have a healthy interest coverage ratio of 4.3 times, while our forward-looking ICR, reflecting annualized income for our developments, comes to 5.0 times, and our normalized net debt to EBITDA to 9.5 times. Our LTV ratio stood at 45.9%, slightly above our 40 to 45% target range. We expect the LTV at year-end 23 to be around 45% as the revaluations of our developments are fully booked. We continue to deem this LTV range appropriate, given the higher yielding nature of our portfolio. We are confident in the outlook for CTP. Despite some slowdown in the macro environment, leasing dynamics in the CEE region remain strong, leading to continued rental growth and supporting valuations. Our pipeline is highly profitable and tenant-led. The yield on cost for our pipeline has been increasing in the first half of the year, and our target for new projects is 11%, thanks to decreasing construction cost and continued rental growth. CTP has the team, the land bank, the balance sheet, and the tenant relationships to deliver on our promises. We confirm our guidance for the 2023 company-specific adjusted EPRA EPS of 0.72 and are on track to reach 20 million square meters of GLA and rental income of 1 billion euros before the end of the decade. Thank you for your attention. We now welcome your questions.